Ladies and gentlemen, you're once again welcome to the Kingdoms podcast. And today is a special episode because I've got with me the CNBC of IG, Taylor Sohns. How are you, brother?
I'm doing well. I'm excited to be here, my man. Thanks so much for having me.
Okay, and of course, yeah, thank you very much. I believe in gratitude, and attitude of gratitude is good attitude. And like I was trying to tell you just before we started the pod, I am launching the King Dames podcast merch. And interestingly, I see you, brother, on IG. I see you here, you wear a lot of face caps, right? And of course, we're starting the merchandise with face caps. This is the very first one, so King Dames, and of course, you've got TKDP just other side. And of course, it is actually in partnership with a brand called 36 Label, which is owned by a friend of mine. So you have 36 here.
Heck
So
yeah. Looks awesome,
guys,
my man. I love it.
let's get it. Let's get it. Go to the link, on YouTube, and of course go to the shopping section, and of course get your copy. And of course, somebody who doesn't have to pay for his copy is Taylor Sons. In appreciation of your participation, Taylor Sons is getting a free copy of the Kingdom's Heart. So diving right into the port, you are called the CNBC of IG. So what does that mean to you? And of course, how did you build that reputation?
Yeah, thanks, man. I've got a background on Wall Street, but I think the downside of Wall Street is they talk in this lingo that nobody knows, nobody understands, and they talk directly over people's heads. So my job is to come in and kind of distill it down into layman's terms. Hey, what
Mm,
does this actually mean to a normal person? Because not everyone is a physician and knows what a tibula is or fibula or whatever. No one knows what interest rates are, duration is. So let me help break down these things into ways that people can actually understand and then act.
Interested. You've got this finance background. You are a CFP, a CMAR, and of course, you also hold an MBA in finance. What inspired you to pursue financial education and wealth management?
Yeah, I think that I grew up in a little one red light town. So out in the middle of nowhere where it wasn't necessarily in the forefront of people's mind, Wall Street, investing, stocks, that was all foreign. But I do have a nerd as a mother. My mother is a statistics
Wow.
professor. So she always has that kind of numbers mentality, brain about things. And everything in our lives were taught to us in probabilities. Hey, what's the frequency this is going to play out? And that's exactly what investing is. It's just playing the odds of probability and trying to
hmm
put them in your highest favor.
Wow. Interesting stuff. I see you like a brother from another mother. I'm also a finance guy, an ACA, what you guys call a CPA in the US. And of course, I have my first degree in economics. I also have an MBA as well. But interestingly, my mom is not from a finance background, but I think my parents inspired me to go into finance, even though I don't like finance. So growing up, my mom used to complain a lot at home that you guys don't know how to economize. You cannot economize this. So she was always talking about economizing so much, And when I got into secondary school, I was very much interested in economics. And I did very well in it because I was always thinking, I want to know how to economize.
Yeah,
So,
totally.
like different inspirations, from parents. And my father, at some point told me, would you like to be a chartered accountant? Okay. The people who do don't have two heads. And then he told me, okay, he just got some money from a contract and he was like, okay, would you go to the school? And of course, I went to the school, registered. He paid for like the whole, what I say, they don't call it terms. It's called a diet. It's the diet of the exams, right? So he paid for like the first level. And of
Got
course,
it.
I aced the exams and history. It's all history. Here we are, being finance guys, speaking with each other, though we came into finance, based on like different motivations, right? Different motivations, but similar destinations. Whoa. So for you, what do you think is the biggest misconception people have about financial planning and investment?
Yeah, I think the biggest problem with folks is they invest first, plan second. And that's
Mm,
totally opposite, right? That's like a
yeah,
ready, shoot, and then aim. It's not
it's
ready,
like
shoot,
talking
aim. It's
before you think.
yeah, exactly. I do that. I'm
Yeah,
guilty of that myself sometimes.
they say think before you talk.
Right, right. No, totally. You're exactly right. So it's the order of operations is off. It's like without the plan of where you're trying to get to, how do you know the best investment vehicle in order to get there? So the plan dictates all of the investments. And then I think when it comes to the actual investments, so many people suffer from what they call in our business paralysis by analysis, where they just analyze everything. They try to peel apart every little detail and then they just freeze and they
Data
don't make
junkies.
any investment. Yeah, exactly. In our country, in the US, they call it deer in the headlights. And it's like deer in the
Oh,
headlights just stand there and they get nervous and they don't move and a car hits them. And it's like,
mm,
don't let yourself be victim to that when it comes to investing.
mm,
Part of the game in investing is that it works over time. So get invested, diversify a portfolio. It's not try
mm-hmm,
to pick one individual investment that's going to knock the cover off the ball. It's pick several investments and make sure that they work together and they have different risks and therefore manage your overall return stream. And I guess at the end of the day, it's dip your toe in, start investing, figure out what you're good at, and then continue to press on that area that you're good at.
interesting. I like your analysis a lot. So back to us being finance guys, you are more into investment. A lot of people, when they think finance, they don't really understand the fact that there are like various areas of finance, right? So for me, I'm more of a practicing accountant. I did work with two of the big four accounting firms. I worked with PwC, I worked with KPMG, and everything we do is born out of risk assessment. And I did like the fact that you touched on risk, right? So I would appreciate you or shedding a bit more light on risk assessment when it comes to investment. You talked about diversifying your portfolio, which
Mhm.
also links back to risks, right? So I would appreciate you shedding more light when it comes to risks.
Yeah, and I can even tie in kind of a current analogy right now where what you look for in investments is margin of safety.
Mm-hmm,
It's okay, if something goes wrong, what does the downside risk look like?
mm-hmm,
And when you look at the market right now, there isn't when I talk about the market, I mean the stock market, the S&P 500 for example, the margin of safety just really isn't all that attractive at this point because stocks are basically at all-time highs. For every $1 a company in the S&P 500 earns, the market is paying $22 for that dollar worth of earnings. And
mm,
that is so far ahead of the long term average, which is about $16 for a dollar worth of earnings. So it's just if you do experience downside risk, you'll have what they call multiple compression, where that
mm,
$22 multiple will come downward. And the higher it is, the more downside risk there is. So your margin of safety really is not there right now. And it's not to say just back out of the stock market and don't invest in general. It's just be cognizant of what it is you're buying. And a lot of the things that people are incredibly attracted to because they've done so well in recent years, their margin of safety is just almost non-existent, and that makes
mm.
them less and less attractive, although the market, broadly speaking, and the end public thinks they become more and more attractive if they've done so well, but it's actually the exact opposite.
You touched earlier on uh doing something that works for you, right? That is sticking to the kind of investments that does work for you.
Mhm.
And I think from a risk assessment perspective, in business school, you know, in any of the finance classes, we're taught that different people have different risk appetites. You have the risk lovers, you have the risk neutrals, and of course you have the risk adverse. So for different people, they have different, would I say, capacities or different propensities in terms of taking on risks, right? So, from your own perspective as an investment advisor, what would you advise people in terms of, taking on the stock market based on their risk appetite? For the risk lovers, for the risk neutrals, and of course the risk adverse individuals.
Yeah, so let's take crypto and put that aside for a second. Historically speaking, stocks have been the highest risk investment that you can make,
Mm.
right? And so you have to understand that the stock market goes like this over time. It's like a sine curve, and over time it goes upwards, but obviously there's a lot of chop between the start and the finish point. And
The
some
peaks and the
people,
troughs.
the peaks and the troughs, and the peaks and the troughs don't bother some people. They're
Mm.
very willing to accept the trough because they know the peak is going to come at the end of the day. Other people see the trough, and when the trough is happening, by the way, the headlines are generally not pretty.
Panics.
Yeah, yeah. So all of a sudden there's a fire down the hallway and it's like, all right, continue to buy more. Do I sell? What do I do? So when people have a lower level of risk tolerance, what they want to do is start to match some things in that do different things than stocks. So you have stocks here, and maybe you have exposure to things like bonds, things like alternatives, in some circumstances, cash. And so they'll act as buffers against the downside risk of the stock market. What you're looking at, so therefore, when stocks are going up, they're going down, and vice versa. And so you can match those against each other. And then if you do get a sell off in the stock market, maybe that asset goes up in value. And then what that allows you to do is, from a position of strength, take some of that asset, sell it down, and buy stocks as they become discounted. Because as you know, stocks become a coiled spring in a time like a recession where they go down, 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 and then that spring releases and they explode higher. So you want to take advantage of stocks as they're going down in value and be a buyer, but you can't do that unless you have an asset on the other side that's doing something completely different. And so that's all of the portfolio construction. And how you construct a portfolio is completely dependent upon that person's level of risk. And that person's level of risk is incumbent upon two things. One is the time frame. As people move into retirement, naturally their risk appetite needs to come down, because you don't want to be drawing money out of a portfolio to fund your retirement as stocks are getting smoked at bad prices you're selling out at that point. But on the other end, so that's the time frame. The other end of it is just what you alluded to before. People's propensity to desire risk, to embrace volatility and downside. Some people run for the hills in nasty times. And those are people that just need a less risky portfolio, because when the market goes down, that's when they want to yank. And that's the worst time to be yanking.
I like to tell people that the two most powerful emotions in human beings always come to play when it comes to investment. And those two most powerful emotions are greed and fear. You, you,
100%.
you agree,
100%. Yeah, yeah.
right?
You think about this. It's like, you go back to Darwin, right? And whether you believe in science or whatever,
Evolution
evolution, or
or
whatever else on the
creation.
other side. Yeah, so we won't go there. But at the end of the day, like, we have definitely seen animals change over time into the beings that they are now, and it's a fight or flight thing. And so when danger presents itself, you either fight, which from an investing standpoint, you can't fight the market. So it's a fight or flight, right? And so that's how things evolve over time. So it's human nature to make bad investment decisions. It really is. And it's fighting that innate human nature that's gotten us to where we are as a population today by making, investment decisions that are very counterintuitive. Hey, let me go out and buy something that's done really badly recently. Like, this doesn't make any sense to anyone. Let me stay away from that stock that's done nothing but make people rich for the past 5 years in a row. This doesn't make any sense. But that's the reality of value buying. Warren Buffett buys when there's literally blood in the streets. No one wants to own a stock, but that's when values are better. And, at the end of 2021, when nothing could go wrong, everyone was piling everything they could own into the market. Their cabbie was telling them what, stock to buy. What happened in 2022? The bottom fell out. So it's just very counterintuitive. Yeah, let me not spend time buying the stuff that's done so well that all my buddies are rich on. It's just very counterintuitive.
Well, counterintuitive. You talked about recessions, right? And my next question is relating to recessions. There's usually a lot of fear around recessions and economic downturns. So, how can individuals and families prepare and protect their wealth during this uncertain times?
Yeah, so it's been a long time since we've seen a proper recession. And what I mean by that is like a true economic contraction. In the States, the last real recession that we had was 2008. And we had a mini one, a very short lived one during COVID, but I call that one kind of a fictitious one, or a manipulated one, because the government literally shut the economies down. But prior to that, the last natural recession was back in 2008.
Yeah, the
So you're
'08 was
almost
a real meltdown. It was a proper
yeah.
meltdown.
It
Yeah.
was a proper meltdown. And literally there was concern that our banking industry in the US, and a lot of the global banking industry, was just going to be defunct and go away. And the government stepped in and piled money into the market to back some of these banks, and we gained our footing and then have since moved up for now almost 20 years in a row. But the reality is, there is a business cycle, and the business cycle generally moves from growth to inflation, and we saw inflation, then it typically will move to stagflation. Stagflation is when you have high inflation coupled with low economic growth, and the market rolls into a recession. And it doesn't perfectly follow that pattern, but what you need to do is you need to look at your investment portfolio or create an investment portfolio that has pieces of it that will work during each one of those time frames. So what works during growth? Stocks work during growth. Like that's the best asset class to be in. As the economies proliferate and grow, so do corporate earnings and stock prices go higher. When inflation kicks up, when inflation is modest, stocks do fine. But when inflation gets nasty like it did in 2022 after COVID, et cetera, that's not a great time to own stocks. So what is it that holds up well during inflationary periods? Typically things you can put your hands on, hard tangible assets. So things like real estate, things like gold, things like oil. That's typically going to hold up well in that environment. Stagflation is a tough economic environment, but gold is another great example of something that works well in stagflation. Stagflation, you have inflation, and simultaneously the economy is not doing that well. So that was
Stagnant
what
economic growth.
that's tough, man. That was what took place in the 1970s, and it was very tough on most asset classes. And so there's that. And then in true recessions, when you get economic contraction, that's when bonds hold their weight. That's when bonds do really, really well. So like a 2008 example, the S&P 500 drew down 49% peak to trough. So you lost half your value in the S&P 500 in 2008. Long-term treasuries were up 34%, positive 34% in 2008. So that just goes to show how you have pieces in the portfolio where something might get beaten up, but something else is going up in value. And then as you get that massive rally out of those treasuries, like I mentioned before, you start to sell down some of this and buy stocks as that dislocation takes place before the pop happens on the other side. But unless you have an asset that does well when stocks are selling off, otherwise you're just riding the roller coaster and hoping that you don't have the mentality where when it's down, you can't stand it at the last point and you go, I'm out. And that's exactly what happens at the worst time if you don't have a properly constructed portfolio.
So, speaking of having a properly constructed portfolio, a lot of people lack financial education. So you need to understand at least the basics, the fundamentals. So persons like yourself and myself are privileged to have financial education to, would I say, to a very large extent, because it's when we think about the proportion, the percentage of the population, would I say the global population, who are privileged to probably have an MBA, like yourself, myself, to you are a CMA, you're a CFP, I'm an ACA, right? So not everybody has that access to understanding financial statements, understanding financial planning, financial projections. So, as a minimum, right, as a bare minimum, what do you think individuals, especially persons who are probably parents and guardians, because they have financial responsibilities, right, over people, and the way they manage these financial responsibilities to a very large extent determines the quality of life that the people who depend on them would live, not just in the short term, but in the long term. So, what do you advise in terms of getting the minimal financial education in order to enable people make well-informed investment decisions?
Yeah, I think it's the responsible thing to do to have yourself at least armed with enough information on finance, on accounting, on different things. When you get a tax return in the United States, they're incredibly complicated, but you got to be able to at least wade your way through and say, does this all look reasonable? Do the numbers at the end of the day make sense?
The
And
numbers numbering.
are the numbers numbering,
Is
right?
it is the mathing?
It's totally right. And like you as an accountant, you would know
Hmm.
far better than I do, but like tax returns are really hard to understand, but you got to
Hmm.
have the responsibility to take enough time set aside to learn and understand that, because otherwise you could be paying stuff to the government that you don't belong paying them. They have to make
Hmm.
sense. And,
Hmm.
everyone makes mistakes, inclusive of the government. So get to work to understand that. Get to work where you at least understand the bare minimum of what investments should do over time. And I think that the easiest way to do some of the investments, and it kind of depends on the level of assets that you have. If you have a higher level of assets, you can either pay someone to do it for you, which that's what my firm does. My firm runs wealth management. So we have folks come to us from throughout the country, throughout the world, and say, hey, I don't have time to do this. I have this level of assets. I make my money at work. I want to continue to focus on that. I don't want to focus on this stuff. I don't have the ability to. You guys handle it for us. Okay, perfect. That's what we do. We understand what your needs are. We get to work. We build portfolios. We understand your tax situation, what have you. On the other end, when you don't have a certain level of assets, unfortunately, there aren't folks like ourselves that are saying, hey, bring them to us, bring our assets to us. It just doesn't work as well. But there are easy options in the market that are diversified strategies in their own right. There are ETFs that are fully diversified products. Now, are they doing the same thing that we're doing for our clients? No, but at the same time, it's a great starting point. So like a multi-asset portfolio, something in the United States that almost all K plans have is what's called a target date retirement fund. And a target date retirement fund, if you're 30 and are going to retire in 30 years, it would look at 2020 or 2055, and you would invest in a 2055 target date retirement because you're going to retire then. And what it's going to do now, because you have a long time until retirement, it's going to be pretty aggressively managed because you have a long time to ride out the bumps along the way. But it's still going to be diversified. It'll still own stocks. It'll still own bonds. It'll still have some cash exposure in the portfolio. As you get closer and closer to retirement, where you can't take big drawdowns because you're going to start to spend that money in retirement, then it'll get much more conservative for you along the way. So I guess there is that easy button out there that is a target date retirement fund for folks to utilize. So understand what it is that it's trying to do. And that's a great route for folks.
So speaking of the media, right? The media tends to influence people's decision making across various aspects of life. But one problem with the media is they often sensationalize financial news. So what's your advice for filtering out the noise and focusing on what really matters?
Yeah. If someone is telling you information, make sure the information is backed with data. And so when someone's in my shoes, the only way I can tell you a story about, okay, here's my take on the market, the only way I feel comfortable doing that, because who am I, is showing you the data that gets me to that conclusion. So if someone's telling you Tesla's the greatest investment in the world, all right, cool. Why? And don't give me because look what it's done in the rearview mirror, because I don't care. Tesla's down 30% in the last 2 months. So, it was the greatest investment in the world because Elon Musk was close to Trump, and therefore the stock price went like this. The market didn't realize, apparently, that Trump doesn't want EV tax credits in the United States. He doesn't want to build out electric vehicles. He wants it to be more open option and not forcing people into owning electric vehicles. Well, Tesla makes electric vehicles. So why did Tesla's share price double in a 6-month period of time, even though Elon's close to Trump, knowing that electric vehicles probably aren't going to be something that the president's going to push into the market? So don't tell me what's happened in the rearview mirror. Give me logic, make it make sense, back it with data. And then you're then incumbent as the individual to make decisions on your own, which is not an easy game to do. So I think it's don't follow, maybe this is self-serving to say, don't follow everyone and get, hey, I want opinions from everywhere, because you're just going to confuse the hell out of yourself. So find some folks that you like, you trust, and then follow them if that's what you're going to do on social media, on podcasts, whatever, and really get an understanding of how and why they think about things. And if you agree with it, then start to listen and make decisions accordingly.
Interesting. That speaks to something I like to say. I don't do what ifs or maybes. I do absolutes. Because you always need evidence to back anything you say.
Well, you're an accountant, so accountants are only number people, right? There's no story behind an accountant. Investors, there's a little bit of a story there too. Y'all just literally do numbers.
I don't do what ifs. I come from Nigeria, and there's a popular saying right now in Nigeria. It's in pidgin English. They say, if you don't get evidence, you go explain tire. So it means if you don't have evidence, you're going to explain I'm tired. So
Yep.
if you don't have evidence to back up what you're saying, you're going to have a long day explaining.
So here's an interesting thought process, because I think this happens to people that invest their own money all the time.
Mm-hmm.
is they hear about something, it's done well, or it's sexy, or it's going to do well in the future, whatever it is. So they invest in it. And what they lack is the actual understanding of why and what's going to drive it to do
Mm-hmm.
well. So then if they do experience a tough time, then they don't have the backdrop, the fundamental to say, okay, I understand why this tough time's happening and this is why it's going to end. If you don't really know an underlying investment and it falls on tough times, then you start to second guess yourself. Did I know why I placed this investment? Was it a
Mm-hmm.
good decision? And if the answer is, I don't know why I invested in this, you're like, I'm out. Right. And that might be right before it bounces off the bottom. It could have been a good investment decision, just bad timing, and stick with it. It's going to play out. But if you don't have that fundamental reasoning behind it and haven't done the work on the front end to understand this is a good thing to be buying, you can get squeezed out at a tough time.
That's very true. A lot of individuals do not have that patience to ride out the waves. They don't really understand that when it comes to assets, investments, right? You have a wave, and the waves go through periods of peaks and periods of troughs, right? So, but for people who have never invested before, what's the best way to get started?
Yeah, the best way to get started is, in my opinion, with ETFs in the States. There are huge tax advantages that come with ETFs. ETFs can be broad based, where they own 1,000 different stocks, 1,000 different bonds. They can be very targeted to own just semiconductor stocks or whatever it may be. They can own both stocks and bonds inside one ETF. The worst way to get started, and it's the way everyone thinks, is buying individual stocks.
Mhm.
Might be sound crazy to people, but my firm has never actively, without a client asking for it, bought an individual stock for a client. We think buying individual stocks is the ultimate level of arrogance in the market. And so think about this. Me as an individual, even as educated in finance as I am, I don't think I have an information advantage over the rest of the market to tell you where NVIDIA is going to go from here. What do I know about NVIDIA that you don't know, or that the broad market doesn't know? They're a great AI company. Everyone knows they're a great AI company. And look at the returns that have been experienced because of it. But do they belong at 150 versus 100 versus 250? Well, who am I to say that, yes, the market is going to deliver those returns in the future? When you're betting and buying a stock, you're betting against the market. So you're betting that you know something that the market does not know. And what we've seen historically is that the collective brain power of all investors in the market is far superior to any one individual's brain power. So at the end of the day, you're saying, I know something the market doesn't know. And then people rebut that comment to me when I make it. But look what Warren Buffett has done buying individual stocks. And it's very true. But what they don't understand is that Warren Buffett spends 6 to 8 hours of his day reading exclusively on companies. And then when he gets interested in an investment in an individual stock or company, then he flies in the management team to Omaha and he sits down with them and says, tell me what your thoughts are. Tell me what you're going to do. And then he makes a decision based off that. So my point here is Warren Buffett does have an information advantage.
Mhm.
You and I do not. So instead of betting that you can outperform the market, just participate in the market. And that's kind of the best foot forward, is just get involved. Don't get too crazy, too sexy. Get broadly involved.
Interesting. And of course, that is why sound decision making is also known as well informed decision making, because decision making is based off information. So many people feel like investment is risky or complicated, but how can they build that confidence, and take control of their financial future?
Yeah, I think it's risky not to invest, right? So if you
Mm.
sit in a bank account in the US right now, if you sit in a bank account, you're getting somewhere between 1 and 3% return. And then the government taxes you. So whatever your income tax bracket is, the interest that bank pays is now taxed. So now you're at 2%, call it, interest on a bank account. Okay, what is the inflation right now? It's about 3.5%. So you're losing purchasing power every year that you sit in a bank account. That's risk to me. That's risk of purchasing power being lost every single year that you sit in a bank account. So the risk is not investing, it's not investing. Now, all investments involve risk. So again, it is incumbent upon you to start to understand a little bit about, okay, what is the risk that I'm willing to take in the market? And again, if you're just a complete novice and just want to dip your foot in the water, there are ETFs that are made up of a highly diversified basket of stocks, bonds, commodities, etc. And they have different versions of them. Some of them are higher risk, some of them are lower risk. And so you can determine which one of those you want to buy. As you get started, my advice is take on some of the lower risk stuff. Why? Because if you're not accustomed to seeing swings in the market, they can be scary. And so you over time understand that, okay, I may have lost 5%, but it came back. And so therefore, I was comfortable with that 5% loss. And after you get comfortable with that, maybe you're comfortable with, something that's a little bit more risky and has some more downside, but over time makes more money than the more conservative investment. So it's all about just getting involved, dipping your toe in, not overexposing yourself where you're going to put yourself in financial ruin if something goes badly. And that's what so many people do.
Interesting. You touched on people who are just comfortable leaving their money in savings accounts with the banks, but
Mhm.
that's like a layman thinking. A lot of people do not understand the concept of time value of money,
The
right?
eighth wonder of the world, right? That's what Einstein calls it, the eighth wonder of the world.
So the time value of money is something people should be more aware of, because you just leaving that money in your bank account, like you said, makes inflation to erode the value of the money, hence the need for investment. But from your own perspective, what are the top three principles that every beginner should follow?
I think time value of money is ultimately incredibly interesting. So as you were doing this, I have a nerd calculator. It's a finance calculator right now. I just said, hey, if you get a negative 1.5% return, and where I'm going with this is if you sit in a bank account that yields 2% and inflation's 3.5%, so that's a negative 1.5% purchasing power return. And you
Mm.
sit there for 10 years, $100 becomes $85 worth of purchasing power at the end of 10 years. So you've effectively lost 15% of your money because the purchasing power has been eroded by inflation. Inflation is one of the key things to understand in the market in general. The other key thing to understand, which what you just alluded to, is compound returns over time. So if you have a 10% return on $100, that gets you to 110. If you have a 10% return on 110, that's not another $10. That's then $11 that
11.
next year's worth of returns. So every year, the money you make, then that money makes money. And so it's a game of compound returns. Like I said, Albert Einstein calls it the eighth wonder of the world because it doesn't seem crazy in short periods of time. But as you lengthen out time and time and time and
It
time,
grows
the numbers
exponentially.
get astounding. So bringing kind of to the next point of like earlier investing becomes more powerful than later investing, right? So if you can invest $100 at 25 years old versus $100 at 55 years old, it is exponentially different because that's an additional 30 years that money can grow. And so early investments are the most important ones. So sacrifice the new car, sacrifice whatever it is when you first get a job out of university, out of college, whatever you call it, and get that money to work. Live, with a roommate. Keep your expenses as darn awful low as you can, because over time, the money you can save earlier on is much more important than it is later on. So delay the gratification over time.
Delayed gratification. That's one concept my father used to, talk about often. Delayed.
Yeah.
Like he was always speaking about it, and I think it sort of became cliche to us because I don't know how many times that man was always talking about delayed gratification.
Yeah. And you're in a better place because of it. I guarantee it.
So you've worked on Wall Street, and
Mhm.
you have had a really, really fantastic experience. The experience is invaluable, but how would you say that experience has actually shaped your approach to investing and financial education?
Yeah, so I'll give you kind of my role on Wall Street because I think it's important to frame that context. So I was what you refer to as an advisor consultant. And
Mm,
what that was is essentially a financial advisor to financial advisors.
mm,
So a lot of financial advisors look great in a suit and tie, and they don't have the MBA, they don't have the CFP, they don't have the SEMA, they don't have any education in finance. So they can tell a great sales story, but then you ask them 3 questions on finance and they're totally lost. And to some of their defenses, when they realize that, and a family brings them 5, 10, $100 million, they go, I'm in over my skis here, and they'll fly in a nerd on the back end. And I was that nerd on the back end to come in and understand what the client's needs, risks, goals were, and then construct a portfolio accordingly. And so all I've ever done is that portfolio construction given a certain individual set of needs. And so we just went from that stance where I tell you, man, I was traveling around the country like a chicken with my head cut off, 3 or 4 nights in a hotel every week. And then I had kids and it was like, okay, this doesn't work anymore. So then we just said, hey, instead of doing this on behalf of other financial advisors, let's just open our own wealth advisory firm. And then we did, and the results have been outstanding. We've been incredibly humble about the level of interest that we've had, and largely it comes from social media. Almost exclusively, it comes from social media, which is crazy because 15 years ago, social media didn't exist. We wouldn't have a business.
Yeah, the power of social media is, I don't know, beyond words to describe. It's extremely powerful. It's a very, very powerful
It's
tool.
good and bad, right?
Yeah, and of course, it's a two-edged sword. It's a
Yeah,
two-edged sword,
yeah,
and that's why, keyword extremely powerful because the
yeah,
power can be used for the good and of course for the bad as well.
totally.
But what's your take, on passive versus active investing? So should people buy index funds or are there like smarter approaches towards approaching investment?
In the rearview mirror, it's been very, very tough to beat index investing. Going forward, I don't know that necessarily will always be the case. And the reason I say that is because you look at the S&P 500 being the largest index here in the US. Right now, 38% of the S&P 500 is in 10 names. And that is the largest percentage. 500 names make up the index ish. 10 of them make up 38% of someone's money. So it's market cap weighted. So if you put $100 into the S&P 500, $38 are going to 10 companies and your remaining 62 is going to 490 companies. So you think you're diversified, but reality is you're not all that diversified, especially when you look at what those 10 companies are. They're the names you know about. They're Microsoft, Nvidia, Apple, Meta, they're Amazon, Google, they're all essentially tech. Tesla's another one of them. And they might not all perfectly categorize as tech, but they're all technology oriented. So you just aren't as diversified as what most people think you are in an index fund. What we tend to like at LifeGoal is we tend to like what they often call factor-based investments or smart beta investments. And what they are is they're not necessarily going to own the entire index. They're going to target companies that have a certain subset of characteristics. And it'll be a set of rules that dictate what companies are held inside the portfolio. So I'll give you an example because this may sound confusing. So we don't use this fund, but a company I used to work for launched a fund. Its ticker was LVHD, low volatility, high dividend. So it was looking for companies that had a low level of volatility and a high dividend. And if you qualified for those two things, you were placed inside the portfolio. So I think the ability to slice and dice the overall index, if you will, into companies that have certain subset of characteristics that you desire might be a better approach going forward than just owning the broad index where there's so much exposure to 10 names that all essentially fall in tech after you've had a massive technology rally. And right now you have valuations, as we spoke about before, you just have market valuations that are really, really high, especially in those top 10 names. So if you do get a compression in valuations, it's going to be disproportionately felt at the index level there, where it might not be if you're in a low volatility, high dividend portfolio.
Yeah, I do agree with that analysis. I think that's pretty much a smarter approach towards addressing or taking on the investment because numbers don't lie. Again, the factor investment, we are analyzing based on a particular data characteristic. And of course, you're also analyzing this data or in terms of the performance over a reasonable period of time. So we are able to assess, based on correlation, regression analysis to ascertain the level of volatility and of course also the returns on investment. And that way we are able to make a better informed decision making. So thank you very much for that one.
I'll give you an example of something that we do like in the market right now. We like companies that are what they call dividend growers. So
Mm,
they're kind of two sets of dividends. One can be a high dividend. The other one is a dividend that grows. And so these are companies, the dividend growers, that every year pay out a higher dividend than they did the year before. So if you think about a company that's able to pay out a higher cash flow to its shareholders, what it means is obviously it has a pristine balance sheet, because if you've paid out a higher dividend for the past 5 or 10 years every year in a row, that took you through COVID, that took you through nasty inflationary pressures of 2022. Obviously, the cash flow coming into your company is sustained enough to pay out more every year. The great thing about dividend growers over time is that if you look at 50 years, dividend growth companies have massively outperformed the S&P 500. So you've seen more upside, but here's the kicker is that when the market gets nasty and we move into a recession, people move into dividend growth stocks. Why? Because they know they have a pristine balance sheet. Otherwise, they wouldn't be able to pay out that higher dividend every single year. So people
mm.
look for a flight to quality, which are dividend growth stocks. The final point that I'll make is that the S&P 500 trades at a valuation, of price to earnings multiple of 22 times. Dividend growth stocks traded about 17 times. And I know that's nerd terms, but I'll suffice it to say this. When stocks have a high price to earnings ratio, they're expensive. When it's low, they're cheap. And so dividend growth stocks are really cheap right now relative to the index, which is the S&P 500, high quality companies that should protect better in the downside of a market.
And of course, in accounting terms, it means the PE ratio is actually quite positive. That's a price to earnings ratio is actually positive, and it is a good indicator that this is a good investment decision. Well, I do appreciate very much that analysis, and I hope our audience are able to peek on this takes in order to make better investment decision making going forward. Now, talking about personal finance and retirement planning. So, with the rising costs of living, how should young professionals be thinking about saving and investment?
Yeah, well, this is where that compound return thing gets really important, because not only are costs rising, but also people's lifespans are getting longer and longer. So even if you retire at 65 years old, which is a traditional age here in the US, you may live to 95, which is 30 more years. So you have to have your money in the market working for you. Otherwise, you're going to spend it to live your life, and it's going to dwindle over time. So that's where you have to take on some risk in the market. There's no reward without given level of risk. You just have to be able to measure and allocate that risk in ways where you're not overexposed to a recession. You have something that's going to do well in a recession for you. You're not overexposed to something that's going to get crushed in inflation. Maybe you have some of those tangible assets we talked about before, like real estate, like gold, like oil. They're going to help offset that pressure. So again, it's about creating a portfolio that's diversified, can weather the whole economic storm, because we know that economies do well, they do poorly, and everything in between, but the portfolio's got to navigate through it. And with longer lifespans that people are living, and still people are retiring at 65 years old, you have to have a portfolio that can grow so you can continue to spend it down over time, living your life. Because if it's not growing and you're just spending it down, that becomes a problem.
So, what do you think are the biggest financial planning mistakes you see people make in their 20s, 30s, and 40s?
I think when they're earlier on in life, it's one of two things. It's either not understanding the value of compound returns, and so therefore not investing, or number two, it's gunslinging. And what I mean by that is they're buying one individual stock, two individual stocks, a crypto, whatever. And then when it goes up, great. When it comes crashing down, that's when they get their bruised up feelings, and then all of a sudden they're out, right? So when you're young, it's okay. You're going to make mistakes, but try to calculate it a little better, because oftentimes young people, and this is what social media tells them, when you're young, take on all the risk in the world. Well, they forget that, yes, if you just look at a textbook, higher risk means higher returns. But that doesn't take the psychology into mind, where when it goes up and then comes crashing down, a lot of times they go, we're out. I'll give you a statistic that'll bring this to light. JP Morgan ran a study. In 2022, S&P 500 was down 19%. The average investor was down 39%. That's what they actually experienced. So that just goes to show you that literally they bought and sold at the worst possible times. How do you double the negative performance without buying and selling, trading at the worst times? So that's early on in life. And then as it comes into the 30s and the 40s, I think the problem becomes more of the paralysis by analysis. Okay, now I have a family, right? And so I need to be cautious about my money because I need to take care of them throughout my life. And then all of a sudden the decisions go from too quick and willy nilly to I'm stuck. I just can't get off the dime and actually get anything invested because I'm scared to death that I'm going to make the wrong decision. So it's kind of this total shift from 20s, they'll gunsling, do whatever, and they get burnt. And in the 30s, either that experience has taught them a lesson, and then they get really conservative, or they're just too overly caught up in the numbers. And at some point, after you've done enough analysis and realize that that's an investment that probably makes sense for you and your family, you just got to jump. And maybe it's cut it up into pieces. If you've got $1,000 to invest, invest it over 6 months and do 1/6 of it every single month along the 6 month period of time. And that's dollar cost averaging, as we've all heard before. And that takes the really kind of swings of the market, that kind of makes it indifferent because you're going to buy regardless on those 6 days over the next 6 months.
So, you being a certified financial planner, what's the golden rule for long-term financial success?
Yep. It's create a game plan, stick to it, invest consistently what you have the ability to invest, and then it's tweak the plan modestly. No big wholesale changes are necessary typically in a good financial plan, but also not touching the plan over time is something that's a fool's errand as well, because inevitably things change. You take a
Mhm.
new job, you make more or less money at the new job, you have another kid, you have another kid, whatever it may be. Things and circumstances change that both you control and then also outside forces that none of us control. If you're a government employee in the United States right now you're now concerned that you might not have a job because we're trying to cut down on our government spend, and that's the point that they're attacking. So okay, and you need to start getting more conservative because of whatever's going on there. Over time, it's have a plan, adjust the plan on maybe an annual basis, make little tweaks along the way, and just chip away at things over time. Nobody's going to make you rich tomorrow. If they tell you they're going to, run the opposite way as fast as you can. If you're working with someone, find someone you align with mentally, and that you like and that you trust. And if you're doing it on your own, do the research, look at it a few times a year, make sure things are going according to plan like you thought they would. And if it's not, tweak on the fringes, but don't make big wholesale changes.
So, how about people who feel they have fallen behind in terms of the savings for retirement? What's the advice for them?
Get started. Get started, right? So, if you're 50 years old and you don't have anything invested, start investing now. I mean, if you're going to be better off down the line. Yeah, if you could rewind the hands of time and start investing earlier in life, totally. That would be the ideal scenario, but no one's got a time machine that I'm aware of. So, no, it's whenever you're at right now, do the best you can to get money put away. And it's funny, a lot of our clients, and I'll put myself in this category, I have the opposite problem. I can't spend money. And I think it's fewer of us that have this problem. And I think it's a better problem to have, right? But my wife would tell me that's not always a good thing. Like, you also have to be able to live and enjoy it some as well. I struggle with that. And it's this happy balance. But I guess my perspective is I would rather worry about it a little bit every single day and not have to worry about it any big events down the line and give me
Mhm.
that freedom. But at the same time, like, my wife does have to tell me, like, dude, you're working hard. Like, you're allowed to spend some money from time to time as well. And it's that
These for the
happy
leaders.
balance. Yeah.
Hmm. So, where do you see the stock market heading in the next few years, and like what should investors be doing to stay ahead?
What's my crystal ball say? No one's got a crystal ball. You know the line about crystal balls, right?
Yeah.
Those that live from a crystal ball eat shattered glass. So I don't know the answer to that. I do think that when you're looking at things broadly, the economy seems to be in the US on at least relatively sound footing, right? You have unemployment that's really low, historically low. You have the economy that continues to produce, economic growth, at least broadly speaking. So I think the economy is doing fine. And I think companies will continue to perform fairly well. I just don't like the value that's being prescribed to companies right now, where every dollar they make, the market's paying $22 for that. That's in the 95th percentile of most expensive stocks have been throughout history. So only 5 times have they been more expensive than they are right now. So I think, if someone were to say gun to my head, like what's going to happen, I think companies continue to grow their earnings, but I think their share price doesn't do a whole lot. And what'll happen is the valuation, what people are paying for that dollar worth of earnings, if earnings continue to expand and the price doesn't go up, it'll bring the valuation down. And that will make stocks more attractive over time. The dollar you pay for every dollar worth of earning will be less and less. It's like buying an apple and saying, like, right now, I mean, literally an apple, not the company. Right now, you're paying $6 for an apple. Well, what if we could pay $5 for an apple? Doesn't that make it more attractive? Yeah. And that's when I and Warren Buffett and other folks like that will get more interested in buying into the market when those valuations get suppressed a little bit.
Okay, so speaking of crystal balls, right? What I see in my crystal ball for the future is AI and cryptocurrency, digital assets impacting the future of investing. So, what's your take on how they would influence the future of investing?
Yeah, I think you're already starting to see AI play out, and one of the reasons that the U.S. government feels that they can cut some of the workforce is because they now have AI and some of that large language stuff that can take the roles of some of these things that might be a little bit more monotonous in their nature. You have big companies like Meta laying people off right now, Microsoft laying people off right now. Why? Well, some of that is being replaced by machines on the back end that can do folks' jobs for them. So AI is certainly here now, but it's very early stage. And what we do need to see is the profitability generated by AI to justify the price that some of these stocks have on them right now.
Mm.
So that's
Uh,
AI. I think that's certainly here to stay. The cryptocurrency, I don't have as much conviction in as you do. It's very different. So where do you live right now?
London, England,
In London. Okay, so you live in London and you're from Nigeria, is that right?
Nigeria, yes.
Yeah, so like I see the use case in some countries that might not have such large established banking systems, right? Where you might not trust the banking system. In the US, in London, in the UK, et cetera, you don't have the use case yet. And without the actual use case of this stuff, it really is hard to prescribe a value to it. And what we've seen with crypto, if you actually just look at the numbers, is that crypto trades in line with the stock market. So think
Mm.
about crypto as a leveraged version of stocks. So if the S&P 500 goes up, it goes up but more. If the S&P 500 goes down, it goes down but more. And so you look at it day to day, it doesn't look that way, but if you back it out and look at it month to month, quarter to quarter, year to year, the further back you look, the correlation
You
is
see the
very,
correlation? Yeah.
very similar. So the long-term correlation of the S&P 500 to Bitcoin is 92%,
Mm,
meaning 92% of the time they're traveling in the same direction. So the
mm.
point of this is, will crypto be a good investment moving forward? Yes, if the S&P 500 continues to be a good investment moving forward. At least that's what history tells us. And if the S&P falters some, crypto is going to falter, but more so.
Interesting take. Thank you very much and for that. Of course, you are a very busy man, and we are about to let you go. But before we let you go, two things. So, wealth and poverty are a function of mindsets, and that's my philosophy, and I hope you agree with that. So, I would appreciate if you're able to quickly provide important advice on, the proper mindset to have in order to achieve financial success. And before you go, I would appreciate for you to provide, the platforms where the audience can actually follow you and gain much more insights into learning about finance.
Yeah, beautiful. So I'll start with the former there of just what's my advice. I'm not a big advice giver, but I will say this: find whatever it is in life that you're better at than everyone else you know.
Hmm.
Focus on that, get even better than what you already are, and then just deliver. Work hard on that. Work harder than anybody else works on what you're already good at. And it's just going to take you and move you higher and higher. And there's going to be tough times. Like I've had tough times in my career as well. But the persistence to just push through is what gets you there. And the knowledge that you are better at someone else, you are better at something than everybody else. It's just figuring
Hmm.
out what that something is, getting passionate about it, and then staying hard work, persistent, and driving that forward is what I think. Doesn't matter what industry you're in. That's how you're going to excel and separate yourself from the masses.
Wow, thank you very much. I do appreciate that because I said exactly that same thing to somebody 2 days ago.
I
Great
love it.
minds think
I
alike.
love it. I
In
love it.
economics, we call it the competitive advantage theory.
Exactly right.
So,
Exactly right.
so find that thing you're extremely good at, and if you work hard towards it, stay persistent, stay resilient, you will go far
Totally.
with it. Wow,
Totally.
thank,
So,
thank you. And of course,
yeah.
where can people get to
Yeah.
find you, connect with you,
Yeah.
of
So
course,
follow
get
us,
financial insights?
as you see, well, on a podcast at Life Goal Investments.
Investment. Okay,
Life
I'm
Goal
going to drop
Investments.
a link to that in the description of the
Yep.
podcast. So,
Instagram, TikTok, LinkedIn, anywhere you see daily videos. We put out 60 seconds daily videos on just, hey, here's what's going on in the market. Here's how to make yourself better, yada, yada.
oh, wow. Okay, so like I love to say, an attitude of gratitude is good attitude. And of course, thank you very much for your time today. God bless you. And of course, hope to see you do greater stuff in the future.
Same right back at you, brother. Thank you so much for the time. It was a pleasure being here.
Okay, and of course, please, if you made it to the end, please subscribe, follow us on our social media platforms. And of course, we will continue to deliver wonderful, inspirational, and educational content going forward. Cheers. From me, it's bye.